Welcome back. A research analyst at the financial derivatives company, Desola Sumoni, joins us now to discuss the latest burning economic issues at the domestic commodities market. Good morning, Desola. It's good to have you on the program. Now, we've seen the price of Brent crude increase to a pre-pandemic high of $46 per barrel, even though it's trading around $45 a barrel as at this morning. But bring us up to speed on the latest developments in the oil market, and where do you see prices going forward?
Thank you for that question, BC. So the oil prices are driven currently by bullish news coming from the Middle East and coming from Asia and the Middle East. First, we've seen in China strong imports from China. We have seen strong imports from strong crude imports from China. Imports for China grew by, I think, 17% in July to about 14.2 million barrels per day, and that is quite significant because China is the largest importer of crude oil globally. We also saw, positive manufacturing and non-manufacturing purchasing managers index from China, which suggests that the economy is healthy and the recovery is underway. We also saw the weaker US dollar. Last week, we saw the dollar weakening against a basket of other currencies. And yesterday, it weakened by about 25 percentage points against a basket of currencies, which simply made the import bill, the oil import bill of holders of these other currencies cheaper and, tempted them to buy some more crude oil. We also saw, the Hurricane Laura in the Gulf of Mexico caused supply disruptions that led to about 1 million barrels to be offline. And finally, in Abu Dhabi, the Abu Dhabi National Company has announced that they will cut oil production by about 30% in October. So all these factors together are why we are seeing oil prices increase. But on the downside, we have resurgence, rising coronavirus cases in key economies. We are seeing in India, we are seeing in France, we are seeing in the United Kingdom, which is also sparking concerns about a second lockdown, which has implications for oil demand growth.
Now,
so
let's talk about
this fact. Okay.
All right, you were going to say something.
Likely to, I said these factors are likely to, cap any price increases we would record in the near term, and we expect price to trade between $43 to $46 per barrel.
All right, now let's talk about data from the Nigerian National Petroleum Corporation, which shows that the organization paid 5.348 billion naira in under recovery in June, and that's despite the fact that subsidy was officially removed earlier this year. Can you talk us through this development and what subsidy removal means for petroleum price?
I mean, in April, the federal government introduced what they call the petroleum product pricing modulation mechanism, which essentially is a mechanism that tracks developments in the global market. So when oil prices fall sharply, like we saw in March, April, the price for PMS in the domestic economy will decline as well. And when prices increases in the global economy, we expect the same in the domestic economy. And we saw that happen in March, April, when we saw sharp declines in oil prices. The price of PMS in the domestic economy also reduced, and when price began to pick up in June, July, the prices increased. But we saw, like you said, in June, figures from the NNPC showed that they still paid about 5.4 billion naira in under recovery, and the argument put forward by the NNPC is that this is payment for stock that was bought before the price modulation mechanism was implemented, and they expect that cost would be spread over 6 months. So it's still a keenly watched issue, whether the subsidy has actually been removed or not. And this is very, very sensitive issue and political issue in Nigeria. But we think that this modulation mechanism is positive, and final removal or permanent removal of the subsidy is positive for Nigeria in terms of savings, government expenditure, and that Nigerians are now beginning to pay market price for oil. I think that is positive.
Now, the CBN has announced the intention to inject more liquidity into the FX market from next week. How will this affect the exchange rate at the parallel market and the price of domestic commodities?
For background, we know what happened with the sharp decline in oil prices, the sharp decline in foreign capital importation, sharp decline in remittances, all of those factors, and the trade deficits created the situation where we did not have enough foreign exchange. And in March or April, I think the central bank stopped injecting FX into the foreign exchange market, and that led to the parallel market rates depreciating to record lows of about $470 per barrel. Now the central bank has come and set expectations that okay, next week we are going to inject dollars into the market, about $20 million to start with. That's about $10,000 for each of 2,000, around 2,000 BDCs that we have. That's about $20 million dollars at the first injection. That is positive. It's like water to parched land. It's supposed to help with the expectations, and it has already started reducing the pressure in the foreign exchange market. But that is not enough, because we still have pent up demand of about $5 to $7 billion, depending on who you ask. And with the resumption of international flights, schools are resuming, particularly here in the UK. Schools are resuming, and last year the United Kingdom issued about 60,000 student visas to Nigerians. So imagine these people that are coming back for school, take tuition about $15,000. That's about 90 million dollars right there that we need to pay this period. So overall, I think central bank is positive injection to reduce the pressure on the FX market, but it's not enough. And I think the impact on the markets will be muted because of prices are downwards.
All right. As expected, Desola, capital importation declined sharply in Nigeria as well as other oil-producing countries. How did we get here? And do you see capital importation picking up in the near term?
The culprits are, again, oil price and the pandemic. But Nigeria is not alone. The data shows that quarter on quarter, capital importation declined sharply by about 78% to about $1.3 billion, and year on year that was about 79%. But Nigeria is not alone. This same we experience capital flights across emerging market economies: India, China, Turkey, South Africa. Even the International Institute of International Finance, which is a body that tracks capital flows globally, estimated that in Q2 alone, about $90 billion left emerging market economies. So Nigeria is not alone in that. But in addition to the COVID-19 down, we also have oil prices, we also have oil price shock, as well as exchange issues, which spooked investors and led to sharp decline in foreign capital importation. So going forward, I think we will only see significant return of capital inflows next year when things begin to stabilize, when the economy opens up fully and economic activity goes in a full swing.
But with the GDP contraction of 6.1% in the second quarter of 2020, of course, the World Bank is forecasting that Nigeria will enter its worst recession in 40 years. How is this recession any different from what we had in 2016? And is the federal government actually doing enough to ensure a quick recovery?
They say misery loves company. So again, I'll say Nigeria is not alone in this. All over the country, all over the world, we're experiencing record recessions. We're experiencing record contractions in GDP in Q2, and more is expected in Q3. But bringing it to Nigeria, in 2016, we had an oil price shock, and delay in addressing exchange rate issues caused the exchange rate to decline sharply and had significant implications for the economy. That was simply a supply side shock. Now we're having both. We're having a supply side shock and a demand side shock, and that's the key difference. But I think in terms of response, the response of the federal government has been quick, right, compared to 2016. So we've seen quick response by the central bank. We've seen quick response by the federal government, as well as the Ministry of Finance. The central bank injected a stimulus package of about 3.5 trillion naira, and the new national economic stimulus plan is also a plan of about 2.3 trillion naira. So this injection should be able, if properly implemented, should be able to cushion some of the negative impacts of the pandemic on the Nigerian economy. And I think that if they are properly implemented, that we should sail through this contraction and should come out quickly on the other side.
Now, just before I let you go, Desola, talk us through domestic price development and where you see domestic commodities price going forward.
On domestic price, if you look at our slides, you see that domestic prices have been relatively flat, and even though consumer demand is increasing, but prices have been relatively flat. We've seen some increases here and there in tomato, same price of tomato increase, price of flour also increase, but generally prices are flat. And going forward, we expect them to remain flat in the near term. But in the medium term, when the exchange rate pressures begin to abate, we expect it also to move into commodity prices gradually in the middle term, but not in the interim at all.
Research analyst at the financial derivatives company, thanks for your time on the program this morning.
Thank you for having me.
We'll be right back in just a